Hi everybody, I wanted to continue with inventories and basically wanted to go through, it's very detailed, so I wanted to reference the text and go through essentially page 149 through about page 159 where we go through them to cover pretty much everything. Basically with this chapter we've been working on current assets, and in the piece about inventories, our goal is to really understand how US GAAP works for inventories and how there's different cost identifications that we can work with, and what's permitted is weighted average, FIFO, LIFO, and that LIFO is not permitted under IFRS. And basically when prices change and cost changes, basically we can have different ways of recording net income, of recording profit. And this is significant also because whichever cost assumption we use affects the value of the ending inventory. And this is a material that can be a little bit involved. So what I wanted to go over first is what are the entries that are involved in this part. So when we record a sale, what happens on the balance sheet? We obviously, when we record a sale, we're getting rid of inventory. So think about it that way. Purchases add to inventory. Sales remove inventory. Of course, the other part of the fact there is a sale is sales increase sales, which is revenue, right? Another entry on the date the inventory leaves, but cost of goods sold gets recorded. And that's the cost of goods sold is really what we're talking about here. This is how we track how much it's actually called, we have expensed of inventory into the income statement. This means that when inventory becomes a sale, it becomes cost of goods sold on the income statement. This is, for one reason we do this is so that we can find out how much it cost us what we sold, and another reason is because we're literally removing what we sold from the balance sheet into the income statement, and it's essentially has become expensed. Now, with these four different methods of accounting for the cost flow assumptions. What is cost flow? First of all, it is a method of essentially tracking which unit will be allocated to cost relief once you sell something. If you think about it, basically when you sell something, who decides which item out of all your items in inventory will you put into the income statement? You know, what if you did like specific identification means you could take any one of them and basically put it through the cost flow. So if it's something that you got 3 years ago for really cheap and you're selling now for really high, you could take the most profit by using specific identification. So there's basically different ways of processing this flow, and we'll talk about it, whether it's first in, first out, whatever you got in first, that's the first one that goes out, or whether it's LIFO, where it's the last in, first out, like the most recent one that you purchased is going to be the first one that goes out when you sell it, or weighted average, where you basically are using the weighted average cost of everything you've had to value your inventory. And essentially this is what we're talking about, is how do we decide which method to use and what is best applicable to the company. So now what I actually wanted to do is, we have a bike example here. What I actually wanted to do is go over the example in the text. They're all similar examples, but if I can point you right now to page 150 in the text, we're going to go through this example On September 1, 2016, the inventory of Cruisers Inc. consisted of 5 models OB3 boats. Each boat had cost $1,500 during the year ended August 31, 2017. 40 boats were purchased on the date and the cost that followed. During the year, 37 boats were sold. So here we have you can see the date of purchase, number of boats, all these things, the total cost. And now for the first one, how do we figure out the weighted average cost flow assumption? Just first, right off the bat, the two things that we're going for is cost of ending inventory and cost of goods sold. So in this situation, what we do is look, weighted average, we basically look, what was the total cost of all the boats? Total cost is $73,980. Divide that by the number of boats available for sale throughout the year. Basically everything that we have owned. And that's 45. So literally the average cost per boat is $73,980 divided by 44. And that's $1,644 per boat. $1,644. And the cost of ending inventory then, we have 8 boats left in inventory at the end there at August 31, 2017. So we multiply 8 by 1,044, and that's 13,152. And the cost of goods sold, since we sold 37 boats at 1,644 is equal to 60,828. So that's what we have, and that's basically what we're going after in this whole problem. Kind of reread it with the mindset. What you really want is to value your ending inventory. So you want to apply a certain price to your ending inventory, and then you want to price your cost of goods sold, because that's going to go on the income statement. So you want to know at what price all the stuff that you sold is applicable to. And you have to basically show the end inventory balance and the cost of goods sold balance. And now that depends, of course, on the method. Now with FIFO, let's see, the cost of ending inventory, and let's see here, the first in, first out. So basically the ending inventory is just going to be the most recent boats you bought, right? Because you got rid of the first in, first out. So you got rid of everything else. So the last 8 boats is what you still have. So you have 4 from August 30th and 4 from July 28th. August was at 1720, July was at 1700. So it's 68. So the price of that is 13,680. 13,680 is the cost of the 8 boats. The cost of the 37 boats sold is the sum of the cost for the first 37 boats purchased. So the 37 boats sold were the first 37 that you purchased. So we go back to the beginning and we go, okay, the 5 from September, 8 from November, and so on, all the way to July, where we sold 2, and 4 remained. And the price of all that, as you see, they multiply out the prices by the units, and the cost of goods sold is 60,300. Now, that's basically your cost of goods sold, and the remaining in inventory is 13,680. And with LIFO, last in, first out, so what remains in inventory is the first 8 boats that you had, which means the 5 from early September, and there was, I believe, 3 from the November period. So we can see that 5 at 1,500 and 3 at 1,600, and we see the cost of 8 boats remaining in inventory is 12,300, and the cost of goods sold is 61,680. So as we see here with this example, what we're trying to figure out is cost of the goods sold and the ending inventory, and it's different for LIFO and FIFO because with FIFO, what's ending inventory is the latest inventory you bought. With LIFO, it's the oldest inventory that you bought. So now, if you think a little bit of the impact of that, if you're keeping the oldest cost in inventory, that's LIFO, and that's actually why in IFRS it's disallowed, because IFRS follows the balance sheet principle, which means the most accurate balance sheet you could have. And LIFO, not that it's bad, but you notice it's keeping the oldest prices, the less relevant prices, as your ending inventory balance, so it could be a bit misleading. And then also, when you look at the different price changes, basically when you have rising prices, which is common, right, with inflation, with FIFO, lower older costs transferred to cost of goods sold, higher more recent costs stay in inventory. So first in, first out. With FIFO, technically, with rising prices, there could be some changes that would be occurring, because you might be recording higher profits because your prices would be more recent, but your cost would be a little bit older. With LIFO, higher, more recent costs transfer to goods sold. Lower, older costs stay in inventory. So basically, with LIFO, you would have less income in a higher rising prices because you'd be using the higher cost. So there's a bit in the chapter, you'll see that there were some companies that were changing their method from one method to another, and basically firms changed from FIFO to LIFO, so that in the periods of high inflation you wouldn't have this thing basically that is called inventory profits, because as you see with FIFO in a rising cost environment, you could basically end up having profits just because there's been some inflation, and you're using more recent prices, older costs. So it's not really you're making money, you're just mismatching the economics of your purchases and sales. And that could also cause higher taxes. You're paying more tax and basically no reason at all. So some companies did change from FIFO to LIFO, I think back in the 80s when we had a really high inflation, and that was something to think about. But mainly, guys, with this chapter, this is what we want to focus on, the methods and the idea of how does these changes in cost flows actually affect your profit, actually affect your accounting. Now, in terms of inventory systems, perpetual inventory system is the one we're going to focus more, especially in fashion. If you think about it, perpetual inventory is when we track each item in inventory using scans, using RFID radio signals. Most of the time they simply scan the item using a scanner, so it's a computer system. And periodic inventory system is like you just check inventory at certain times. So this is more like, I know some grocery stores use this, where you kind of just check, oh, at the end of the month, how much of this do we have? Or at the end of the day, at the end of the week, how much of this do we have? And we determine based on that how much inventory we've sold. So we use the perpetual inventory system, and that's the one where you track, a constant flow. And that's how companies basically nowadays really track their cost of goods sold, is using a complete computerized system.